What is going on, everyone? Steve Parisi here with IBC Global. Today we've got a treat for you. We are going to talk about infinite banking and whole life insurance and really what we hear frequently. When it comes to the idea of infinite banking, this attracts so many people to whole life insurance, particularly in respect to the cash value. But what we hear so many times, just through phone calls and working with thousands of people, is, Steve, I get the idea of infinite banking. I understand the concept. I'm interested in a whole life insurance policy. However, what I do not understand is whole life insurance. I want maximum cash value. That is what I am interested in. Sometimes we even hear, I don't care about the death benefit at all. So to take that a step further, what I want to understand, again, if I'm a consumer, this is what we hear, is who uses these policies and how do they use them? Because I hear of big corporations, big banks, wealthy individuals using whole life insurance specifically for the cash value, but tell me more. I'd like to really understand it and not just move forward with it based on a partial understanding. So to provide some more information on who uses cash value life insurance, we've got 3 examples up here. Banks, March 2020. Remember that? That's when COVID really came on strong in the US. Everyone was panicking. What did the stock market look like? Specifically during March. Yeah, it was tanking. What did interest rates look like during March? They were already very low and they're going down even more. I remember getting a text message from an officer at a bank and all it said is, Steve, we have a large pile of money. They gave a specific dollar amount, but we have a large pile of money that we need to move ASAP. Guess where they put it? Cash value life insurance. When you look at all of the major US banks, often the number one asset on their balance sheet in respect to their tier 1 capital, which is among their that classifies their safest assets, is typically the cash value holdings in their life insurance policies. Interesting statistic, isn't it? If you were to look at corporations, I've got a construction company written down here. So a little bit my background. During my earlier years in the industry, I had the privilege of working for a company where I designed policies for corporations. And really my goal was to design policies, analyze different companies, look at historical performance, very nerdy back office guy, data driven, like that. That was my personality. But I remember working with a construction company, or I should say designing the policy. I didn't work with them, to be transparent there. I designed the policies on the back end, and I heard what the owner had said. The owner of this construction company had a number of whole life insurance policies, some with major mutual companies, some with smaller companies, and they had performed quite nicely over time. And he said, you know, as I look at these policies for a number of executives for our company, when it comes to whole life insurance, my policies have been some of my best performing assets. The owner had money in real estate, stocks, bonds. He went further to say, with the exception of the interest I have in my company, in his construction company, my whole life insurance policies have been my best performing assets. And the main reason why he stated that, he said, last year I made a $12,000 payment to one of these policies and the cash value grew by $48,000. Now that policy was 30 years old. In 2008, his value just continued to appreciate. It was a peace of mind product. He did not have to worry about any type of fluctuation. That's really what did it for him and gave him that, I like this product. But it has to be set up properly. But we see how banks use it, how corporations use it. That was a particular case where we put policies on a number of executives. The company owned the cash value products and the cash value was an asset on the balance sheet and the owner was very satisfied with his products. That's why they did it. Then we see the wealthy, $200 million policy. So did you know within the past decade, within the past 10 years, a wealthy individual, a billionaire, purchased a large cash value life insurance policy of about $200 million. And I did not get to sell this policy, unfortunately. However, it is the largest single policy on record of ever being sold. You can actually Google search this. But my point to this is when you do Google search it, he made a comment. He did not care about the life insurance one bit. When you Google search it, you'll see the quote. It reads that he purchased the life insurance policy purely for cash value. He saw the growth, This is a fixed asset, a safe area for him to position money. That's what he was doing along with the tax benefits. So how do people use it? Why are they using it? Both individuals, because what he did, almost everyone can do with an individual policy if it's set up properly. Banks use it, corporations use it because it is effective when it's set up correctly. If I transition into the basics, so some education on whole life insurance, because going back to the beginning, I'm interested in infinite banking, but Steve, IBC Global, I don't understand whole life insurance. Tell me more. I want to understand it before I move forward. So with a whole life insurance policy, we've got three main pieces. We've got a premium, which is level for the life of the policy. I've got cash value, and I also have a death benefit. So with a life insurance policy, the premium is level for my whole life. Now, with the word whole life insurance, how long do you think you have to pay into it? Well, naturally, I would think my whole life. It's in the name, right? Which sometimes is the case, but if you do things right, you can have a policy where you pay into it for 2 years, maybe it's 5 years, maybe it's until age 65, you stop and go, fluctuate with your different payment amounts. That really leads into policy design, but I'm not going to touch on design today. My point is we have a premium that's level for our whole life. However, we do not need to pay into it for our whole life. Very easy to accommodate a design where we stop early. We have a death benefit that typically gradually increases over time. Now, death benefit proceeds on policies every single time, whether it's a whole life insurance policy, term policy, universal life, whether it's a MEC, doesn't matter, the death benefit is paid out income tax-free. However, it is not exempt from estate taxes. Typically, we need to do a special type of trust planning in order to accommodate that, but income tax-free, death benefit proceeds are paid in that manner. Cash value. Here's the part that intrigues everyone. The cash value, as the years pass, go nowhere but up. If things are going very, very well in the stock market and economy, or if things are going very, very poorly, that value just continues to go up. I have a guaranteed rate associated with it, nowhere but up. This, going back to the construction company and the owner, this is what he was attracted to. Now, with whole life insurance, if you want to pretend for a moment, if you were looking at a policy, let's say you buy one, you put money in, it's maximized for cash value, but then your cousin, your sibling, a mentor of yours who is very savvy when it comes to finance says to you, why did you put money into a whole life insurance policy? That is one of the worst areas you can position money. And you put money there and you're like, I can't explain it. Only if you could talk to my guy, the agent I worked with, they could explain it perfectly. And then you're in that situation like, no, they just ripped you off for a high commission. As we've all been in situations like that, whether it's life insurance or anything. So how do we explain it? Well, what I like to say here is if there's anything to remember, what are the core benefits, the main features to a cash value life insurance policy when I'm interested in the cash value and I want to copy what these guys are doing? Here you go. Remember these three things: safe, liquid, tax-free. Safe, liquid, tax-free. That is a cash value life insurance policy when it is set up properly. So, safe, to provide some more information. My money's not invested in the stock market. Net internal rate of return, the net growth rate, will typically fall somewhere between 3 to 5%. Now, this piece is very important to clarify here because confusion always stems from this. So, if I pull up Dividend History here, this is one of the major mutual companies. What do we see for 2021 on the 2021, and then what do we see on the far right? Dividend interest rate, 5.65%. That is their declared dividend rate for 2021. We see a guaranteed cash value interest rate of 4%. That's their floor. Now, depending on when you're watching this video, as of 2022, all new products have a lower guaranteed rate, and it depends on the company and product. But if you have a policy that was purchased in 2021, the 4% guarantee was locked in. But how it works, anytime you see a dividend rate, I have a 4% guarantee. That means a surplus of 1.65% was declared. Add the two together, 5.65%. Now, question for you. If you have $100,000 in cash value, earning 5.65%, what should that equate to? If I was earning 5.65% in a bank account, well, $5,650. If I had a dividend rate of 6%, so it was a different company, that should equate to what? $6,000 in interest. That, with whole life insurance, is not the case, not even one bit. Anytime, this is important here, anytime you see a dividend interest rate, that is a gross rate that is credited after the company's insurance expenses, what they classify as mortality charges, everything. So to demonstrate that, so if I go back, or if we go back to the whiteboard, what do we see? Net growth rate of 3.5%. Net. Let's take a look. I'm going to pull up an example of a policy with a 6% dividend rate. Let's make this a little bit bigger. Now this touches on policy design a little bit because we see where the money's going. We see a 45-year-old individual. He's 46 at the end of the first year. Let me do this actually. There we go. $46 at the end of the first year. Where's the money going? $10,000 base premium, term insurance rider, everything else funneled into PUAs. This is an example with a level term rider. Total payment, $100,000 per year, breaking down where the money's going. You can identify this on a full illustration with any insurance company as well. But first year, just about 89%. Now, here's what I want to touch on. This is a product that has a dividend rate of 6%. I pay in $100,000. I have about $89,000 in cash value the first year. Did I earn 6%? No. I lost 11%. So I've got my gross dividend rate, but after the company's insurance expenses, I net out at a negative 11% internal rate of return. Important to make that transparent, build awareness there. Second year, I pay in $100,000. The cash value grows from 88 and change to 184. Dividend rate illustrated here is 6%. That often changes year to year. But the actual growth rate, if I isolate year one to year two, I get less than the 100K I pay in. That is why I have a negative 2.15% internal rate of return, growth rate. Now, as I look at this each year, here's really what I want to touch on. What the yellow represents is when I break even, when I have more money in the policy than what I've paid in. But as I look at this, if I go down to the peak earning years, and this is the annual IRR, not the average, what do you notice here? This assumes the dividend stays at 6% forever, which typically does not happen. 6%, 6%. The IRR, annualized, tops out at a little under 5%, meaning that the insurance expenses associated with the product indefinitely pull down that gross earning rate. And that's valuable to be aware of. And I mention that because, we've spoken with individuals that put away $5,000 per year, $10,000 per year, $500,000 per year, and this comes up all the time. I was told I'm getting a dividend rate of this much, which is the truth. However, it is a gross dividend rate. I want to know simply what's the actual growth rate? How much did my cash value grow by? And if I crunch it on a calculator, what does that come out to? And I've got my death benefit appreciation as well. But safe, I will see it produce in the neighborhood of that 3 to 5% range as the years pass, if I do everything right from a design standpoint. Liquid, I can access it anytime I want. Typically 10 days after I start a policy is when most companies permit me to access the cash value. And then always compounding. So this part most people get when it comes to the idea of the banking concept. And then tax-free. I used to always say tax-free if, and it is tax-free if I do everything properly. And the big if here, I do not want to trigger a modified endowment contract. If that happens, cash value grows tax deferred. But anytime I want to access money with the MEC, what happens? gains are taxed as income. And you also have a 10% penalty tax if under the age of 59 and a half. But it's easy to prevent. And then no lapse. If a policy lapses or if I cash it out and there's a gain on it, meaning more money in the policy than what I've paid into it, that will also result in a taxable event. So I hope you enjoyed this video. Please, if you have questions, comments, leave them below. Feel free to reach out anytime. If you did like it, please hit the like button, hit the subscribe button. If you didn't like it, I like you anyway, and we'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.